from yesterday, some questions you might want to ask yourselves. Maybe you are in your operation. How are your customers evolving, right? And what do you need to do to stay ahead of the competition, right? What are your competitors doing to better find, market to, and bring those customers into your store, right? And do you see your customers moving to a digital or mobile channel in large numbers, right? Are they finding you first online, and what does that mean, right? How are you marketing to them? What does that mean from a risk perspective? Is it a different consumer, a different risk profile? How do you understand them? And then finally, are your customers using more non-traditional credit products, right? Credit products that you typically won't find on a traditional credit report. You may have to understand from a little bit different perspective. So with some of those questions in mind, we posed some questions to ourselves, and what do we think an independent or a buy here, pay here dealer needs to be successful? This doesn't cover everything, but just a few things that kind of lead into what Mike's going to talk about. Certainly, online verification capabilities, right? So income and employment verification, it has to be consistent and repeatable and measurable and affordable, right? Affordable tools. Fraud tools and identity verification, right? So the confirmation of place of residence, right party contact information, all those tools are extremely important to be successful. The third piece, which we think is becoming even more important for a dealer to be successful today, is to leverage alternative financial information to assist with predicting early pay defaults, right? And that's where this whole realm of alternative data comes in, right? And the question you might ask yourself is, well, what is it? How do we define it? It could mean a number of different things. It could mean credit, non-traditional credit consumer data, or non-credit consumer data, right? There's a couple different categories. Mike's going to talk about those things and how you can apply them within your operation to reach more consumers, underwrite more consumers, and fund more deals. So I'm going to hand off to Mike if you want to give a little background and context on what you're talking about.
Sure. Thanks, Rich. So I'm going to talk a lot about data, but I want to talk about it in the proper context with you. So feel free to guide me if I get off course. But I don't want this to be just a monologue. So feel free to interject with any questions as I go along here. So I'm going to do a couple of things. I want to talk about the success we've seen auto lenders have using alternative data. I also want to talk about the evolution, the definition of alternative data, and what we see the evolution of it becoming, and then how we try to take more data from different places, disparate places all over the universe, and try to make it more consistent, repeatable, and online so that you can use it to have greater insights on your consumers. So we'll start with trended credit data, and I don't know, does everybody in here pull a credit bureau report, I'm assuming? Okay. Everybody familiar with trended data? It's the difference. This is really the difference between the historical credit bureau view and the current or the future credit bureau view of a consumer. And I'll talk about why I think it's important for your population. Your population, for the most part, is pretty homogeneous at a credit bureau. Not in every case, because we have a broad group of folks here, but if you're non-prime, you've got some good stuff and some bad stuff, maybe a little more bad stuff than good stuff at the credit bureau report. And so the question is, how do you or your lenders make the decision as to how to price this deal, or which deals to buy and which deals not to buy? And so this is where I think trended data, it becomes important, because really I think you're trying to do a couple of things. One, if I can verify you as a consumer, then I think I can underwrite the deal. The question then becomes, how do I price the deal? How do I price the risk for the deal? And so one of the things that you really gain insights from trended data on is the capacity of that consumer to pay. I mean, at the end of the day, in this non-prime consumer, really stability and capacity are really the keys. And so what we see in the trended side here versus the point in time credit side, is the point in time tells us this guy, obviously this is probably not your consumer with a $250,000 mortgage balance, but just an example. So you have a $250,000 mortgage balance with one late payment in 6 months. You still have that information over here in the trended view, but now you also have the fact that this person previously made additional payments on the principal but now only pays the minimum payment each month, and they're building balances on multiple cards. You might see that there are cards over here, but you would not see that balances were being built, and you would not see that they were previously paying more than the minimum, and now that they're only paying the minimum. So that's a change. That's a risk change that you could see. When we add in alternative data, and I'll define that more completely later, but just for this, for sake right now, that's data that's not traditionally reported to a credit bureau. So that's things like payday loans, rental data, utility data, those types of things would be considered alternative data. When we add that in along with a home value estimate, because we actually now have the appraised home value on an annual basis for whenever a transaction occurs for the properties in the U.S., we see that this person is actually $100,000 upside down. They've gone from making principal payments to only paying the minimum. They've got building balances on multiple cards, and they've recently taken out a payday loan. I understand this may not be your consumer, but I think what's important is the insight, the difference in the insights from this view to this view, right? This looks like could be anybody. This is someone trending the wrong way. And so I think for you, what you want to find is somebody that's trending the opposite direction of this consumer, right? They may still have some blemishes on the credit report, but are they now starting to rehabilitate, or are they attempting to rehabilitate and improve their credit? So we talked a little bit about alternative data and what the definition is. So we bucketed it here for you. But again, the theme is that it's data that's not traditionally at a National Credit Bureau reporting agency. And I didn't do this earlier, but my background is in 2000 I started a company called L2C, which was an alternative data credit reporting agency. And the concept was really pretty simple. I'm from Atlanta and was talking to some guys that run CompuCredit, which was a subprime credit card company at the time. And they were talking about how they underwrote differently than the big credit card issuers. And so we said, well, what if we took all that data and actually created it as a service to other lenders to utilize as well? And so what we did is we aggregated a bunch of data that wasn't on the credit bureau report. So it was not a mortgage, not an auto loan, not a personal loan, and not a credit card. Anything else was fair game, right? And the primary goal was to capture insights on that consumer's capacity to pay. Yeah. Where? So we can talk about it in a couple of different contexts here. So because a lot of these data sources are the same ones, we'll talk about the place that they kind of come from. But essentially, we either went out and created situations where the data was generated, or we purchased it, either on a transactional basis or in bulk, and then matched it to consumers. But we were a credit reporting agency, and all the data that we had was permissible purpose data, so it had to be used in a credit transaction. It was the only way you could get access to it. So alternative credit data, short-term, single pay, short-term installment, typically payday loan, right? It's either like a payday loan, buy here, pay here auto, rent-to-own furniture, something that looks like that, right? Today at TransUnion, we have two different data sets we use for this, and combined they cover about 70 million unique U.S. consumers. Really predictive data, mostly negative, overwhelmingly negative, because the challenge is those loans are really expensive, and the people that continue to roll them over get themselves into a position where it's hard to pay them back. What you're looking for are people that are trying to pay it back and are having some success paying it back. And you're also looking for other insights on the application, because these applications occur every 2 weeks. So the question is, if I see this guy 6 or 7 times, is the employer the same every time? Is the address the same every time? Is the bank account number the same every time? Are funds coming in and out of that bank account? Is the Did I say is the phone number the same every time? Yeah, so all those things are insights that I think are useful when you're underwriting. Obligation data. So some of this data we don't yet have at bulk, but I'm going to talk a little bit about what we have today, and I'm going to talk a little bit about where I think the whole industry is going and where we're trying to go. And some of you, if you watch basketball, particularly college basketball, you probably saw Experience Boost commercials. Anybody see those? Enabling a consumer to add data to their credit file. You know, I'm a big believer that utility companies don't want to report to the Bureau, at least not positive data, and they won't willingly do it. Rent data is just too fragmented. There's really not a way to get it at scale that makes it useful, unless it's a very manual process, right? And it's still not at scale, but it's useful for your particular purpose. And then telco carriers are not going to report. So there's really one source of that data to get it at scale, and that's the consumer. Now then the question becomes, how do we verify it? How do we reduce fraud? And how do we do all those things, right? And then how do we handle it as a consumer reporting agency if a consumer supplies data and then disputes it? So we have all those issues to tackle, but we're working on those things. We're going to be able to make some of these things available to you in an online environment. So for instance, if you have a consumer that's applying and you have a STIP and you want to be able to verify that they paid a utility bill or proof of residence or things like that. We're not there yet, but we're going to be able to bring those things to you in an online environment so that you could just have the consumer give you the credentials and log in and pop that up versus leaving and having to go get a utility bill and bring it back in. Yeah. Yes, the challenge is how do you actually get it onto the Bureau before the consumer's standing at the point of sale, right? And so, and how do you do it at scale? I think those, yes, I think we're all trying to get there. I think the question is how do we get there as an industry in a way that everybody's comfortable using it from a lending perspective. Clearly the consumer is going to be comfortable providing it, but the question becomes, particularly with rent, what happens if I just pay rent to my buddy over here and he kicks it back to me and I just keep paying rent every month to my buddy and he just keeps kicking it back to me and all of a sudden he's not really paying anybody anything, right? But he's got a trade line that looks like he is. So we have to be careful with some of those things by adding them in without the proper controls in place. But yeah, we're trying to make that available, and so are some of the other players. Some of the other data that we consider alternative data that we have available today would be things like checking account history. So as I talked about this, one way you might get some of this data is just by enabling the consumer to link their checking account to their credit report. Right? That's essentially what Experience Boost product does. We'll be able to do that as well. And the interesting thing from our standpoint is once I link a checking account, how do I verify that that's not just the good checking account, right? That they didn't just give me the checking account that they're paying today, but they have this other checking account out here that they have all of these bounce checks and closures and things like that. So we have a national database, and this is one of the databases we had that we purchased for a long time, which is essentially used to open up DDA accounts at banks today. And it's a fraud screen, if you will. And so what it shows me is how many inquiries you've had for a checking account, how many bounce checks you've had, whether or not you've had an account closed for cause by the provider, not by the consumer. And so when we add this type of data from a checking account, we can also screen to make sure that that's the only checking account that that consumer has, that they're not just cherry picking what they're giving us. Assets, tax and deed records, public records, real estate, foreclosures, judgments, and liens. So all this data, aside from this, because we don't have this at scale today, but this data and this data is currently in our alternative data solution set that we provide to auto lenders today. And one of the things I want to talk to you about is how do you actually leverage it? So we'll go from very basic to relatively complex. We make it available on its own or as part of a credit bureau pull. So you could pull it with a credit bureau as an add-on product, or you could just pull it on its own if you either want to pull a credit bureau from somebody else, or you don't feel like the credit bureau report is adding that much value for your particular situation, whatever the case may be. So phase one is a filter. And so we talked a little bit about some of these things like payday loans and whether or not somebody's habitually delinquent on a payday loan, or if they take out a bunch of payday loans and just never pay them back, or say they have a bunch of bounce checks or a bunch of checking accounts that are closed for cause. You could simply pull that data in and just exclude consumers that had one of those indicators with them. You could include those consumers that have positive, whether it could be positive payments made, whether it's payments remade on a payday loan, whether it's we have other data sets that capture some positive payments as well. And so you could include those or exclude others that have negative occurrences. And then you can set some out for additional screening. So you can work your waterfall, if you will, by using that data. So this would be phase one and what I would consider to be relatively simplistic, but we basically can just use this data to include, exclude, or just manage the waterfall. This is a little bit more complex. So what we've got here is a traditional credit score, Vantage score, and then a Credit Vision Link score, which is what we call our alternative data score that incorporates all that alternative data we talked about earlier. And so what you see here, I'll show you a better slide in a little bit here, but what you see is a matrix of using these two scores together and where you get the pockets of low-risk populations and the pockets of high-risk populations. And so these would be people that you would exclude theoretically or price differently. These would be people that you would include or price differently, as well as in here you would grade your pricing out. So this is, a more simplistic and a more complex example. I think this is a pretty interesting slide. I'm going to put it all up here for you because each of these might mean different things to different people. So as I go back to that simplistic concept, the question might be, how do I create a strategy around some of this data? Well, bank accounts. What I can tell you is the consumer is going to have a higher rate of delinquency when they utilize several bank accounts over time. The lower the number of bank accounts, the more stable that consumer is, the lower risk that consumer is. Address stability. The longer they've been at the same address, the fewer address changes they have, the less risk that consumer is. Contact information. Almost the same as this one. When they have one cell phone on file, it's consistent, been the same number for a long time, lower risk. If we see multiple numbers on file, it changes frequently, higher risk. Delinquency, obviously, if they're going bad on short-term installment loans, they're likely to go bad on traditional loans. And so they're going to be just higher risk in general. Positive payments is the opposite. Even if they have experience with the subprime loans, if they're paying them back, they're getting used to that process, and they're actually working to fulfill their commitments, and so they have lower risk. Even if they're in those short-term loans, they're lower risk on traditional products if they're paying them back consistently. So I think this slide's important because as we think about other ways you might incorporate this data into a strategy, it's not all just did they bounce a check, did they get their checking account closed for cause. It's the other information around the transactions that we've captured that can be insightful and useful for you. Obviously, validated employment. Again, I talked about if they are applying multiple times over a course of a year, and every single time we see the income, stated income's about the same, the employer's the same, the checking account is the same number, and we're seeing funds flow through it positively, good indicators. I'll let you take a picture. Yeah. So you're talking about something like this. This is the blow up of that last slide that had just that colored chart down there. So what this is say you have online applicants or applicants coming through the dealership and you're sending them off to get quotes, price quotes on them. So this is us returning traditional credit scores, and that earlier scenario was a Vantage score, and an alternative credit score. Now, where it would go into a decision engine, potentially with the lender. We do this with a lot of the big lenders today, and we're starting to talk to dealers about it so that they can understand what else the lender is looking at, to understand why they may have made a decision that didn't look like the decision they would have made just on the credit bureau report alone, right? But what you see here is pretty interesting. So this is inverse from the last slide, but this is the highest risk quintile 1. This is the lowest risk quintile 5. What's interesting is, okay, if you wanted to target a bad rate of 20%, you might buy this whole quintile, right? You might buy all of these consumers. The problem is you probably don't want them. You could probably live with all these, right? Because they're going to average below 20%. But you wouldn't know, unless you added the alternative data, you wouldn't see this group alone as being sliced out with a 41.5% bad rate. Obviously, these rates are also important. They may not jive with the delinquency rates you're seeing, some buy here, pay here, but the concept's the same. Say I want to target a 5% bad rate. Again, I'm comfortable. I might even be comfortable with this group. I don't want this group. Twice my target. Same story here, and same story here. So, because we've incorporated all of this data that's not at the credit bureau, you get a different orthogonal look at that consumer. And it's just just think about it as having a more holistic and broader view of that consumer. So I'll come back to that, but this just kind of talks a little bit about the strategies that we see in the auto space. So a fuller picture of a consumer, understanding the consumer's credit more completely, swap in and swap out. We talked about those things. So, if they have checking accounts closed for cause or multiple charged off payday loans, maybe a swap out candidate. If we see positive payment performance and consistent phone history and consistent checking account history, swap in candidate. Universe expansion. So this is in your marketing universe. We can again target on those same criteria, right? So who would you want to be targeting to? And holding other things constant. So for instance, say I want to target a 600 credit score, a 550 credit score, whatever it is, but I want these other characteristics to be constant. Say I want a population of a 550 credit score that hasn't moved in the last year, that has a confirmed bank account with money flowing through it, and has the same contact number for the last 12 months. We can run that campaign. Yes. Yeah, good question. So there's a couple of ways. I mean, direct mail probably doesn't apply as much to a dealer, but digital could. So potentially, we give you all this information behind the scenes. If you want to run a Facebook campaign, who would you pick in Facebook, right? You want Facebook profiles that fit this kind of credit profile that have these other aspects to it. Correct. I'm not going to show you that today, but we could talk to you about that offline, yeah. Any other questions? So we talked a little bit about this slide already. Any questions here? Anybody want to spend more time here, or I can go? So this is generically at a high level what we see on average with a lot of our non-prime auto lenders. They incorporate alternative data at the underwriting stage, and these are some of the results. So a 22% improvement in predictive power just means the model got stronger, right? We use a fancy term called a KS, which just means it's the ability to separate the goods from the bads, and it simply just means the KS went up by 22%, which is a lot. That's good. 32% of the previously declined and unfunded loans could be booked at acceptable delinquency rates when we take into account this alternative data. So we have greater clarity as to who the true risks are and who the people are that are trying to improve their financial situation. And then if we assume some sort of funding rate, we see it up to a 19% increase in the portfolio size from these additional approvals. So these are pretty powerful. Auto has been a really big industry for us for a long time in the alternative data space. And so we'd love to talk to you a little bit more about how we can work on the dealer side as well so that you understand more what the lenders are looking at out there. So in summary, I think Rich talked about some of these things earlier, and I didn't talk a lot about the steps, but understanding one of the things we're trying to do is automate some of the STIP requirements. So some of the verifications that you have to have, you know, how do we verify whether it's identity in an online transaction, whether it's phone number, whether it's address, whatever it may be, how do we do that for you in an online environment so that it can be faster, better experience for your customer, those types of things. And then as we think about STIPs, how do we bring income or validated or verified employer information to you? And so, you know, we're thinking in our mind we should have a variety of options where, and they'll have a variety of price points. Do you want validated income, which means I've seen this person 20 times in the last 2 years and every single time the employer's been the same? Or do you want verified income, which means I saw it from the bank account and this is who puts the money in there every week or so? There'll be different coverage, there'll be different price points and those types of things, but there'll be options for you, whichever one works for you. And then alternative financial information, I think we've talked a little bit about this, but it's, you know, are they bouncing checks? Are they getting checking accounts closed for cause? Are they taking out payday loans and are they paying them back or not? And that separation in there, even in the subprime space, gives you a lot of indication as to who's going to pay, who might be a good customer for longer, and who might just go bad right out of the gate. So I think that's it today. Any other questions we can answer? Yeah.
So TransUnion has customers all over the U.S., both very, very large and small as well. So we count many thousands of dealers among our customers, and we have a centralized sales team in Philadelphia where that manages all of our relationships, onboarding, contracting, and providing products like alternative data through the credit report to dealers. So we can provide that. I can get you that phone number, and we have a really great sales team in Crumlin, Pennsylvania that can work with you to answer any questions you have. Yeah, sure. Any other questions? We have a few minutes left. Yeah.
So it's, you mean the old, you're talking about the one that's the new FICO score? Yeah. He asked if this was similar to the Ultra FICO score, so the way that process works is it's a partnership with Experian today. Experian has a function called Boost, which is essentially enabling a consumer to add data to the report. That's got to be the first step, because then the FICO score will go pick up that data and calculate it in that Ultra FICO score. The difference between what we're talking about and what the Ultra FICO score is the Ultra FICO score takes into account some of the checking account information that we talked about, like length of time of a checking account, whether there's a positive balance at the end of the month, any kind of bounce checks, those types of things. So there's some of that overlap. It does not have any payday loan information in it. The Ultra FICO score does not. And so I think there's some differences. But I would also tell you that we're in the process of enabling consumers to add that data to their credit report. We'll be announcing that before the end of this year. We think there's a two-step approach there. right? We think you have to have what I would call the biller side and the payer side. The consumer is the payer. The biller is either the landlord, or it could be the cable company, or it could be the utility provider, or it could be the phone company. The gap I see today with Ultra FICO, and one of the reasons why it has to be a new score, is because they don't have the biller side. If you have the biller side, what you have is the date that bill was due and the total amount it was due. If I just look at the checking account, I only see what the consumer paid. I don't know if they paid it on time, and I don't know if they paid it in full. The problem with that is I can't just stick it into a credit report in a Metro 2 format. If I have both views, I can stick it into a credit report, and then the Vantage score or any score out there can actually use it. So you don't have to buy a separate score. So that's why we're taking a little different approach, because I only want to drive adoption. I just want to drive consumer adoption. I don't want to have to force lenders and consumers to adopt something new. That just takes a lot longer. Yeah. I can't hear you. TransUnion. All TransUnion. Yes. Yeah. We can. Yeah. Yep. Any other questions? Yeah. Mm-hmm. Sure. So you're talking about this one? So these are bad rates. So what you see here is this is called our Credit Vision Links 2.0 score, which is our latest score, which incorporates our acquisition of a company called Factor Trust, which is a payday loan credit bureau. This is the Vantage score. These are different score ranges, and what you see are the bad rates, 90 days plus rates for each cell, right? So a 574 plus a 632 has a 58 basis point bad rate. 574 plus a score 613 to 631 has an 86 basis point bad rate. So these are the delinquency rates using the two different scores together. Over 90, yeah. Yeah, it does. See, the colors are supposed to be, you know what, you're right. These are flipped a little bit. Yeah, okay. So 39 basis points. Oh, that's unscored. Sorry. So 71. Yeah, I'm not sure if that's a true matrix or it was just an example of one. But you're right. But theoretically, what you should see is something like, yeah, this is the one that this is what you would expect to see, right? I'm not sure if that other one was just a graphic to show the way it could work. But this is an actual business case one that I put on here. So this is just risk-based pricing, where using the two scores together, you can get, you target a bad rate, and then you price around it for, you're going to lose some people because you're going to price them too expensive. This is how you price them more aggressively. Or if you want to price for the risk of the people that look the same but look the same in a traditional credit score but have actual alternative data indicators that determine that they're going to be higher risk or lower risk, you can change the pricing. Yeah, so you basically take a geographic area and say I want consumers, call it a 575 credit score, whatever, call it a 600 credit score. So I want everybody who's a 550 to a 600 credit score that has also this or higher as an alternative data score, and you want to buy everybody in that geo that sits in those buckets. Yes, you can do that. You would get, well, we don't just give you their name. Well, we do. If you're going to mail them, I guess it depends on how you want to contact them. Do you want to do a phone campaign? Do you want to do a digital marketing campaign? You would get a way to contact them. Depend upon which method you wanted to use, whether you wanted to use mail, telephone, or digital. Sure. Yeah. No, they're the same. It's the same product. You're just using it on different populations, right? You're either using it on the people that are already in your shop, or using it on the people you want to come to your shop. It's just two different populations, but you're applying the same product. There was a question. I thought there was. Yeah. No, it would be bank account driven. And so one of the challenges we're working on is how do we get net back up to gross, right? Because that's the different view. One's a net view versus a gross view. Yeah. So we'll be in market with about a dozen early adopters, I would say, in Q3 this year. We'll probably run it for 6 months with them, and then I'd say Q2 next year we'll be rolling out something for everybody else. Well, I can give you a card and we can talk about it. Yeah. How are we doing on time? Got 5 more minutes. Any other questions? Yeah. So we have odds charts that would be nationally driven off if you just wanted to use the 2 scores to set a threshold or a strategy, right? A score strategy. We would give you odds charts that combine the 2 scores on a national population so that you could then hone in on the bad rates that you wanted to target, and then you set your score thresholds appropriately. Sure. Yep. Mm-hmm. Sure. Oh, thank you. Thanks. Glad you enjoyed it. Yeah. We do. Yeah. I might not understand your question. Can you say it again? Yeah. No, I think we can just plug our data to the back of your portal. Yeah.
So we had a few questions on how to contact TransUnion, and I apologize. I should have put a last slide up on how to do that, but I failed to do it. So you can always go to our website, transunion.com, to our business section, and there's a link where you can request information, and there's a lot of detail on our different products and services, including what Mike has talked about today. But you can also call our new business contact center. I'm going to give you the phone number, and again, I apologize for not putting it up. We'll also stick around afterwards. You can get a business card from Mike or I. That number is 866-922-2100. So we have a really good staff of sales professionals who can help explain any product or solution you're interested in, not just credit-related solutions that might. Sure. 866-922-2100. All right, so we offer a suite of solutions from marketing solutions, fraud and identity solutions. Two of my colleagues are here, and we have a booth in the Expo, a contact database solution for skip tracing, collections, and ID verification. Might be interested to take a look. They're at those two gentlemen at the back, Phil and Jay, so right in the back. And again, Mike and I will stick around afterwards to take a few questions, or we'd be happy to provide you with our card as well. Again, thanks for your time. I really appreciate it. Some great questions. Enjoy the rest of the conference.